Once again, thank you all for joining us this morning from wherever you are. We're excited to get to this discussion. I think it's one of our first industry-focused webinars of the year. So food and beverage, it's attached to our Deal Connect directly following, where we're pairing up investment bankers and capital providers for one-on-one meetings in the food and beverage space specifically. But enough about that, a little bit about Opus Connect. For those of you I have not had the opportunity to meet, my name is Lena Dobrier. I'm the Director of Operations at Opus Connect. We're a lower middle market M&A focused professional organization that caters to M&A transactional professionals. So we're membership based. Our membership primarily consists of private equity firms, investment bankers, lenders, independent sponsors. We do a number of events throughout the year. I think we're up to 350 now, if you can believe it. So a lot going on, webinars, Deal Connects, Opus Mind meetings, Lunch for Six. So always an opportunity for you to get involved. If you want to learn a bit more about us, who we are, what we do, how we can help, definitely contact my colleague Swayze Yancey or anyone on the Opus Connect team, and we'll be happy to answer any questions that you may have. During today's discussion, we will be taking Q&A. So the way that you can participate is that Q&A bubble at the bottom of your screen. You'll want to type your question in there, and our moderator, Steve, will be monitoring that, and we'll try to get to as many as possible. These events would not be possible without the support of our sponsors. I don't think I see Fran in here, but Fran Yurkovic of Alliant, they've been a longtime partner with us the last few years. She's based in Chicago. They're an insurance broker, one of the largest or the largest in the country. If you want to learn more about them and their offerings and how they can support you in your deals, please feel free to reach out to Fran directly or reach out to me. I'm happy to pass her information along. And then, of course, Whithum. We'll give it a moment, but Steve Brady from Whithum is going to be moderating today, so he'll give you more of a deep dive, but we definitely want to shout them out and thank them for their ongoing support. And today we're going to ask two poll questions before we get started. And this is gonna help us get an idea of who you are. So we're gonna launch this first question. Go ahead and submit your answer when you see it pop up on your screen. We want to know who you are. Are you advising? Are you in private equity, investment bank, strategic, or other? Let us know. This breakdown will help us. We'll give it 15 seconds or so, and then we'll move on. Okay, last few seconds to submit your response. So 6% advisors, 29% private equity, 24% investment bank, 12% strategic, and 29% other. For you all on the panel, something to make note of. Thank you all for participating in that. We have one more question before we begin, and this relates to today's discussion. How many, if any, have you food and beverage transactions have you participated in the last 5 years? Let us know. Last few seconds here. Okay, so 19% none, 1 to 5 transactions participated in over the last 5 years, 25%, 19% have participated in more than 6 to 10, and 19% 11 to 20, and 19% also over 20. So that's massive. Thank you for noting that and participating. And without further ado, I'd like to introduce today's moderator, Steve Brady of Withum. Steve has been involved in a number of Opus events. He's been a great partner for us. He is also a partner and market leader for Withum's transaction advisory practice. He's a licensed CPA in Illinois. He was previously a CFO. He brings a wealth of knowledge and wisdom to the discussion. So we're excited to have him lead today's webinar. So Steve, I'll kick it over to you.
Yeah, thanks, Lena. Thanks for that great introduction. Certainly the whole panel, we're excited for our discussion today. That last polling question, amazing. I don't think we could have got a more even distribution across the level of activity of everybody. So we look forward to the discussion and imparting some what's going on in the market to those of you less active. And obviously many of you are very active in this space. So in our firm, in our transaction advisory practice, likewise, very active in food and beverage, and really looking forward to the discussion with my fellow panelists. So we'll go down in the order of my screen at least. So Brent, if you want to introduce yourself, and then we'll go on to Richard.
Yes, thank you, Steve. Yes, my name is Brent White, and I'm with Gage Capital, and I cover the food, consumer, retail, restaurant vertical here at Gage. We're working out of our third fund. It's an $850 million fund that we raised last year.
Richard?
Sure. Hi, everyone. My name is Richard Chen, calling from Toronto, Hawkbridge Capital. We have a big focus on consumer and food and beverage sector. And we've done a lot of works in the baby food, food deliveries, grocery deliveries, energy bars, healthy product, vegans. So very happy to share some of the thoughts and the experience during this webinar. Yes.
And Kathleen.
Hi, everyone. I'm Kathleen Lauster. I'm with Fairfield Capital Advisors. We are a New York City-based lower middle market investment bank. We are actually relatively industry agnostic, but we focus strictly on family and founder-owned businesses who have not yet received institutional capital. So, as I mentioned, while we are, somewhat industry agnostic, I do have a fair amount of experience in the food and beverage space. Going back to beginning with my time at Procter & Gamble, where I focused strictly on food over there in Folgers, Sunny Delight, and Pringles at the time. Fast forward to today, and I'm spending a lot of my time in the seafood distribution space. We've got a few clients in that space, one seeking to be acquired, another a buyout opportunity for an owner or one of the owners, and seeking growth equity. So we've been really immersing ourselves in recent months in that space and kind of getting up to speed on what's going on specifically in seafood.
Yeah, thanks, Kathleen. And again, for the audience, obviously with the cross-section of us up here on the virtual panel, great coverage in a number of different sectors, and we're going to hit on as many as we can in this discussion. And as Lena said, really to emphasize any questions, type them in the chat box, because we love if this is interactive with the audience. So again, fire away questions as we go through it. But let's start with just kind of a broad overview. Certainly, anecdotally, the food and beverage sector is very active. And I think all of us in the audience and up here obviously see that, but we did a little quick research from Capital IQ just to give the audience a little sense of 15 recent deals in the food sector. And obviously Capital IQ tend to be, a lot of these are bigger transactions, but the median enterprise value to EBITDA from those deals was 11.1. So, 11.1 multiple, I think, doesn't surprise probably anybody up here on the panel, at least, certainly. And also enterprise value to revenues was an interesting benchmark at about 0.9. So valuations remain strong. Again, anecdotally, we're seeing a lot. And I think certainly a close friend of our firm, and the transaction's been announced in the New York press, at least. I think an interesting deal recently was D'Artagnan was sold, private company, been around for about 40 years, was an early farm to table movement company. And again, one of my clients looked at this deal, so got to read the background. It was really interesting that over 35 years, they were a pioneer in, free range meat, all natural organic poultry, game, and other products, and focused on selling to top end restaurants and retailers throughout the U.S. So it was an interesting deal, and I think very touches a lot of different things and sectors we're going to talk about. So with those few data points, Brent, again, just from a high level, what are you seeing in the market? What's your commentary on that?
Yeah, so last year you saw 2 years worth of deals fit into one. You're seeing frothy multiples. This year, I think all the deals that didn't trade are coming to market in Q1 and Q2. You're going to see a new crop of deals at the latter half of Q2 and headed into Q3. But then you're going to see the effects of the recession, as I think you're going to see a significant drop off in Q4. But that's what we're seeing in the market currently.
Okay. Richard, what's your pulse on the market, and certainly, especially in the sectors you're looking at?
Sure. Yeah, I would say we are looking for the core valuation driving dynamics. If we're looking back for 7 years, when the May 2015 the tech bubble collapsed, a lot of investor capital looking for cash flows, so pushing the valuation, the consumer brands, baby food brand, pet brands, the highest in history in 2016, 2017, and then the valuation fails. During the COVID happens, we see the valuation and attractions coming to the e-commerce, the channel ladder dynamics. So on high level, we see the B2B. There we see the multiples of 2 of the PS, and if it's a B2C, it tend to be 2.5 to 3.5. And if it comes to cosmetic e-commerce, it's coming to about 3 to 3.5. And if it's exotic, e-commerce, pet food, e-commerce, female and baby food, it's getting even higher. But overall, we see, as Brent said, that maybe the market would get a little bit of cool down before end of this year, but also depends on the consumer's habit. Will they gonna stay, or are they gonna go back to the offline after this COVID?
Right. Yeah, and Kathleen, again, from a market overview standpoint, what you're seeing in food and beverage, and activity wise, valuation wise. You're on mute, Kathleen.
All right. So in terms of activity, I echo what Brent said, that we finished the year really strong. There was some uncertainty of where we would be heading in first and second quarter this year, but it doesn't seem like the deal flow has slowed down substantially. There is still a significant amount of dry powder out there looking for deals. Additionally, in this industry, as is in many, really, I find these days, there's the demographics of privately held companies where you've got founders who are aging baby boomers and looking to retire, and the children don't want to take over the business. So just naturally, they've ran the business like a lifestyle. And so they're going to be making lifestyle decisions about exiting that business regardless of where the market is. So we see it pretty strong right now. It may slow down a bit in the second half of the year, depending on how where the market is, but we still see a fair amount of activity to be had. And right now, the market is rewarding strong management teams. That's really, really important. Teams that can take companies through some of the ambiguity and uncertainty that we're facing ahead of us. In terms of market multiples, just looking over, quarter over quarter, and I'm speaking specifically on seafood right now. And what I've seen is that EV to revenue multiples have remained pretty even, about just under a little bit shy of 1 times. But the EV to EBITDA multiples have actually increased. And what I attribute that to is some erosion of margins, due to inflationary pressures. The industry has generally done a good job of maintaining margins and passing through costs. It'll be interesting to see if they can continue to do that.
Yeah, that's great insight and interesting to hear those statistics kind of play out with what we were seeing. So, I think the interesting part you touched on, and we're going to dive into sectors in a minute, but with those demographic and some of the companies, family held businesses or closely held that you were talking about, Kathleen, we're seeing in something in this industry, again, we'll dive a little bit more into it, that really understanding that margin and what it is a critical factor. That I'm probably saying this because I've got a couple live examples where they've got a great product in food and beverage, and there's a lot of trendiness and consumer taste to it, but not always ready for you in your case to take them to market. So interesting part of the sector. I will say we've got a question and a chat comment in. We are seeing them, so we'll get to that question. I love the first question, but I'm going to save that for a little later in our discussion. Let's dive into a lot of the main kind of key sectors of food and beverage. We wanted to have the discussion to bring it down to those sectors, and let's start with branded products. And Brent, let's start with you, and Richard, you obviously do a lot and focus in this space. You can follow up with Brent, and again, open discussion. Kathleen, of course, you can jump in at any time on this. We're not parsing it out. And again, to our audience, please fire any questions at us. So go take it away, Brent.
Yeah, for the first time in a decade, you're seeing branded outpace private label, and I find that astonishing. And what's driving that is you're seeing more consumers have disposable income. They're not going to work. They're saving on gas. They're not picking up that cup of coffee. They're saving money there, and they're not taking those vacations. So they're staying at home, buying their familiar brands. And then another thing that's driving that is you're seeing retailers try to gain margin back. So they're putting a lot more of their name brand items across the shelf. I see this trend reverting back as you see interest rates increase, and you see you're not seeing stimulus in the economy anymore. And the millennials will drive that trend as well, as they don't have any brand awareness or any, they're not tied to any brand right now. So that's what we're seeing so far.
And Richard, from your perspective with those deals you're working on.
Yeah, absolutely. Yeah, we are very actively working on a number of e-commerce related food companies. I want to share some of the misses and some mythbusters about I call them a growth paradox for consumer in the beverage. It's because for food and beverage, it's essential. The good news is people always need them. Doesn't matter, good economy, bad economy. We still, eat the same amount of bread and the same amount of meat. But bad news is margins are visible. How you can win, how you can sustain the second growth curve, third growth curve in the low margin, and naturally a low growth, sustainable, stable industry. There are different stories that we see in the market. And some are real, some are, you probably need to have a second look. The first story is called cross-selling. We see that stories, we see the consolidation plays. If they have the real networking effects, it's true. If it's just traditional, I'm a baby food company in one country and buying another one, the effects actually is very limited in our observation. The second myth is called brand loyalties. So oftentimes I see B2B brands has more loyalties because they have software tagged on. They don't want to switch because of a one-time discount. But for food deliveries, for grocery deliveries, customer loyalty is very low. If one party offers $5 discount, you can collect lots of the new customers over a week. And the third one is tech enable. Tech enable is real. We see technology focused food companies buying low tech companies on the low multiples of EBITDA, and the efficiencies, money saved, and the operational results are dramatically improved, typically over 6 months of time. Not overnight, but over 3 to 6 months, you see the results. And also, another one is capital. Because the margins are low. We see some company, they're trying to expand. They want to grow almost like a software companies. It does not work. The bank loan just does not work. The company, if you want to grow as a consumer food and beverage company, you need a capital backers to embrace that 30%, 50% growth year over year. We see companies stretching themselves, borrow money, expanding to new cities, open new warehouse, deliver new services, just getting so much stress on their EBITDA. Yeah, it's so risky. Yeah, so that's what we are seeing on the market right now.
Right. And Kathleen, you may have something to add to that, but also then you can take that into our second subsector of proteins and do some observations there.
Yeah, so you asked about branded versus non-branded, and specific to the seafood sector, it's a little less mature of an industry. It's certainly a growth area in the market. Consumption of seafood, I wish I don't have the statistic in front of me, but it's been growing substantially vis-a-vis other protein alternatives, that be meat and chicken. And the industry is still largely fragmented, and so the brands, there's just not a lot of brand awareness yet. We do see that evolving over time, and one way to differentiate is via prepared meal kits. Right now, there's limited prepared meal kits in the seafood space, but we're starting to see some opportunities there, and that's a way to achieve higher margins as well.
That's great. And Brent, on the topic of proteins, and I know you've at least seen some things in that sector. What's your observations?
Yeah, so you're seeing consolidation in the meat industry, and they're having more pricing power. You're seeing the big four control a lot of the pricing in the market right now. You're also seeing a shortage of meat supply driven by the pandemic and a labor shortage. At the peak of the pandemic, you saw beef and veal were 21% higher than the previous year, and I think pork was 17% higher. So you're going to see this trend continue moving forward. I don't see it alleviating anytime soon. So that's what we're seeing in the protein space currently.
Okay, yeah, and certainly a lot of interest in that sector cross border. Sorry.
So one thing, kind of switching topics, I don't know if that's okay, but Richard kind of brought up something that I wanted to expand upon as well, and that is the reliance on leverage to fuel growth and the limitations of that. And that's something, that capital was easy to come by, and over the last couple of years, and debt, forgivable debt, PPP loans, et cetera. Obviously, that's starting to change, and there's a need for companies who want to grow to have equity to fuel that growth. And I'm sure it's not singularly an issue in seafood. I'm sure this is a situation that spans other parts of the food industry. But an interesting, unique characteristic of the seafood industry is they're only harvesting twice a year. And seafood, it's all frozen. And this is the shrimp I'm talking about specifically, and they are and they're warehoused in cold storage facilities, and that brings out a lot of inventory challenges because they're holding inventory for long periods of time, much longer than banks are willing to lend against. And then the second challenge, independent of that, is the shortage of cold storage facilities, which is something that I think has impacted the entire market. So anyhow, there's a need for equity capital to deleverage some of these companies a bit and to fuel some of that growth, cover some of the inventory and possible strategies for supplementing vertical integration, cold storage facilities, et cetera.
Yeah, certainly adding to that comment on the cold storage industry, certainly we've seen activity in that sector too, and certainly some of the big REITs are obviously focused and playing in that space, but they're depending on the region of the country, a lot of more regional players who have been strong historically, and again, kind of interesting seeing the impact of the REITs, and to your point, Kathleen, the need to increase capacity. So that's a sector to keep an eye on also. Grab and go, I'm going to touch on briefly, because we've seen a lot of deals in the grab and go sector being companies producing grab and grow product at a big scale. I mean, it was a hot sector for quite a while, and then the pandemic accelerated, the shift of consumer preferences, and some of the distribution channels like grocery, were all of a sudden more focused on product that was grab and go nature versus shelf space and other products. It certainly created a lot of opportunities for these production companies, but also it's been a mixed result that certainly what I've seen in several companies, part of their channels was to airports, to hospitals, to other institutions that, at least during the pandemic, were largely shut down, or certainly the demand went down significantly. So it's been a mixed result in the grab and go sector. But so I think as we're, knock on wood, coming out of the pandemic and certainly past the worst of it, that will start easing as we all get back on airplanes and get back in airports, and at least our loved ones can have visitors when they're in the hospital, et cetera. But it's an interesting sector. And another important one certainly is restaurants. So Brent, I know that's an area that you've got quite a bit of experience in.
Yeah, so the restaurant industry is very interesting currently. You saw Darwin's theory play out in real time. The strong got stronger, the weak kind of died off. The restaurant dealt with a lot of things during the pandemic. They dealt with closures, cost increases, and labor shortages. The ones that fared pretty well were the ones that implemented new technologies, the ones that partnered with third-party delivery, and the ones that had an omni-channel approach. So the ones that were able to get their customers through the drive-through in 90 seconds did really well. The ones that implemented curbside pickup, where you can come in and pick your order in, did pretty well. The restaurant industry literally fits 12 years worth of technology into 1 year. But you're seeing a trend where everybody wants to get out of the house and just be about and spend a little more of their money. So I think the restaurant is poised for growth moving forward.
Yeah, it is interesting. And fortunately, many of the strong did survive. I know hearing that commentary again, as people get back out in the world, they're glad that some of their favorites are still open. Richard, did you want to add to that discussion?
Yeah, I see 3 revolutions happening with restaurants. The first one, they have to scramble to get a cheaper supplies, which means they embrace more of B2B e-commerce grocery supplies. They can skip those intermediaries. They will buy directly from farms. We see that's getting more of a trend, because they need to save that $2, $3 before they didn't care before. The second trend is they are scrambled to find a partner to have the food delivery functions with third-party service providers, and that's another total war battlefield. And the people they have to force the restaurant to make a pick. Say, hey, I'm your only choice for Asian food deliveries. I'm your only choice for mainstream deliveries. So they have to somewhat make a decision. And the other thing is I have to mention is why takeouts are still so expensive. Because some you cannot decrease the value because of the drivers, the gas and everything. You just can't save that anymore. So what can be saved is the rent and the waitresses. So we see there's a growth of centralized locations, but the valuation of centralized locations is quite interesting. Even PS does not describe that story. So right now they're on a per kitchen basis, and hopefully will come back to PS, and hopefully eventually come to PE because it's not a high tech. But right now it's on per kitchen. How much of dollar per kitchen valuation? Yeah. So we see some interesting story happening there.
Yeah. Well, and some interesting stories, just to move on to another sector of grocery. And I know certainly I've seen several deals, and just understanding the dynamics of the businesses, and again, reacting to the change in consumer preferences. And groceries obviously been a very competitive industry for a long, long time. But now having to shift in different products. And again, Richard, I think you've done some stuff in grocery. And anything you want to add to that?
Yes. I would say there are 3 things we see is the immigrants communities in North America. They're starting expecting, say, hey, although I live in New York, I live in San Francisco, I live in Toronto. I want to eat my hometown authentic snacks. I want to use my hometown cosmetics. I want to eat my hometown sausages. And those international delivery supply chains are getting way more developed just over the last 2 years than the last 10 years. The second is we see a greater combination of South America, North America, we call it counter-seasonal fruits and food. So, before we don't expect to eat the blueberries or strawberries so often in the wintertime, where at least we expect the price is going to be much higher. But right now, I want to have blueberries as cheap as the summertime. and this whole integration of global supply chains, we just see that representing a big opportunity here.
Yeah, it's a great point. And I know that, we through our global network have seen shifting gears a little bit into just the production side, farms and other ag production companies, global interest in this sector and global interest in that sector in particular in the United States. So it's, that's going to be something to keep an eye out also coming up. And I think the last sector we want to touch on, and then I'm actually going to go to a question that went in the chat box. I'm going to switch it up, panelists, in a minute. But, ag tech, we're working with some growth equity investors and certainly seen some fascinating businesses throughout the ag tech area, whether it's helping the restaurants deal with the pandemic, as I think Brent said a little while ago, or providing e-commerce solutions, or certainly again on the production side, farms being able to be more efficient. But again, Richard, I know you've spent a lot of time looking in the ag tech sector. So switching it up, a question that came through. It was really interesting, and Brent, you made the comment about the recession, and I'm going to read the question verbatim because I just thought it was a great one to interject. But what recession are you referring to? And I think, again, to kind of break our discussion here, how do we see that playing out? None of us are going to make broad economic predictions, but certainly as it affects food and beverage, there's some impact with inflation and the recession. And again, Brent, you used the word, so we're gonna let you start the discussion.
Yes. So I think you're starting to see a lot of precursors. You're starting to see inflation. The government took away stimulus packages. You're seeing increase in interest rates, and you're seeing inflation. And then with the overseas war, these are all signs that recession is looming. And I think you're going to start seeing a pullback and a slowdown in Q4 or Q1 of 2023. We've been going so hard in the US. At some point, the music has to stop, and there will be a correction in the market.
Yeah, I think 12 years is the streak we're on. So you're absolutely right there. Kathleen?
Yeah, I've been spending a lot of time in Europe in the last couple of months, and it feels like it's already there. I don't know how long it's going to take for that to hop across the pond, but the trend seems to be in play. I don't think that it's not going to be a repeat of 2008. We don't have anywhere near that kind of leverage, and there's still a substantial amount of liquidity in the system. So there will be a correction. Multiples are going to come down. Deal flow may slow, but I don't think it's going to stop altogether.
Yeah, and I'll add to that last comment. I really emphasize what Kathleen just said. Certainly, I think all this is going to affect deals, and it's certainly going to really impact less quality deals out there. But there is still so much capital chasing deals that I don't think we're coming to a grinding halt. That's my personal view. But Richard, your view. Go ahead, Kathleen. Sorry.
No, just one thing I was going to say. Like so many things, I feel like in post-COVID, that there's a bifurcation. There's the strong companies, the strong players, whatever, are going to do very well. And there's going to be a lot of demand for them. And the weaker ones are going to struggle to find capital.
Yeah, great point. Richard?
Yes, yeah. So I see that companies, especially they are functional. They have a certain chainsaw that other people cannot copy so easily, are still going to do particularly well, or they own particular niche market that other people cannot attack. But for general's valuation, we definitely see the pressure from secondary markets. But in terms of first, gross equity, and for example, we were looking at a honey technology company. So they have a way to take the water out of honey. It's not my client, okay? So there's no conflict of interest here. But that company has been growing dramatically over the last, 2 or 3 years because of COVID. People have throat issues, so they want to take that. I would imagine if we invested with the company 3 years ago, 4 years ago, going to do really well today because they have something unique. One thing we realized for food and beverage is there's no patents. That's the funny part of the business. Doesn't matter how it's secreted, as the formula is, Coca-Cola, but the reality is I can throw $100,000 at any co-packer and get something just almost as good as you are. Right? So, so every time we help a client to tell the brand story, tell the, by the end of the day, it's about how long in the supply chain you can take control. If you can supply the supply side, it's great. Right? You can say, hey, I only got a small farm, organic ingredients. So by ingredients, I'm ahead of you. Right? Co-packer, so-so. Everybody's have to attain to the food safety certificates. There's not too much you can do there. And then we come down to execution. My warehouse has more output than you on a per square footage basis. And I have more robotics than you in my warehouse. I don't think that's a chainsaw. So by the end of the day, I feel that there are 3 things can sustain. One is I call it how much of the area of the occupation in consumers' heart you can occupy. Say, hey, I'm the number 1 in the Asian food delivery. That's something other people cannot shake it in a short time. Secondly, you really have something function about it, something really, really unique. Or like Kathleen said, you have a unique source of shrimp, unique source of lobsters. I know seafood is a big time short supply. It's not a market issue, it's a supply issues. And also the third one is about scalability. If you're big enough, you can have better price, you can have better negotiation powers. I think those are the 3 things you can count on.
Yeah, great
And
points. Go ahead, Brent.
To end it on a kind of a joke, when you see Warren Buffett kind of become more active and get out his checkbook and start buying, that's when all your little spider senses need to start poking up like, okay, there's something coming, he sees something coming. So
that is a great point, and appreciate the humor, but also very, very much a reality. So great point. Let's talk a little bit about channels. Obviously, what's happened in most channels in food and beverage has shifted over the last few years, and now again coming out of the pandemic, the landscape's changed somewhat. So let's start with direct to consumer and kind of wrap e-commerce into that discussion at the same time, slightly different but the same in many regards. So Brent, why don't you kick that discussion off?
yeah, even before the pandemic, the trend towards direct to consumer was already apparent. During the pandemic, physical sales channels failed us and online transactions increased. They increased actually by 74% compared to the previous year. And then consumer goods companies saw, I think, a 70% growth coming from D2C channels. You're going to see this trend continue as more people are doing a hybrid work model, and they're cutting out the middleman to preserve their margins.
Yeah, great point. Great point. Richard, you do obviously a lot of e-commerce, so.
Sure, yes. I think it depends on after the COVID world, if I can guide it from my local stores or not. If I can, I always go there. It's almost like a leisure for me. In North America, where traffic is much better than Asia, and it's almost like an entertainment. I go to the store. I like the shopping in the store, compare, banana to banana, apple to apple. I like the experience. But some of the products, you cannot buy it from local stores. It's somewhat just only available from certain e-commerce platforms. Some exotic product from other countries, some Asian products, some particular juice, particular drinks. you can only buy it from there. So I think those as a unique, distribution rights, unique sources, unique co-brandings, those are less affected by this, new COVID world. And I do think students, they don't have cars, and the big shopping center tend to, not close to subway locations. So I think a student market will continue to do well. But for white collars like myself, driving to a local grocery store, buying off a stop and save some dollars, I like it. So I think some of those would roll back. But kind of repeating myself, if they have something unique, they can continue to do well. Yeah.
Right. Yeah, that unique experience is going to be important, and the whole retail grocery chain. Again, we've touched on it a lot, but certainly to mention that as an important channel, and a number of deals we worked on over the past year in particular. I'll say more retail outlets, like not a restaurant, although they're providing food in a retail environment, other types of food products. I mean, that's been interesting. There's been a ton of activity. We've had some bigger clients really looking to expand and take advantage from a, I'll just say, location standpoint, that many types of restaurants, as Brent said earlier, they were not the strong and they didn't survive, and now you have locations that people are looking for and potential retail outlets. But I guess my question of the group, who's to tell what's the long-term impact of how much will we go back to people going into stores, versus, well, I know how to order my groceries online now, so I'll just still have them delivered, or DoorDash, or other things that were, again, accelerated during the pandemic, and how that all impacts retail and grocery and other things. A very broad question, but Kathleen, I don't know if you want to
Sure.
jump in there.
Those changes are here to stay. Just the convenience factor of it, whether it's getting, people will still want to go, and they're going to continue to go out to restaurants now that they can, and that may, offset DoorDash to a degree, but the grocery deliveries, that the technology, advanced 10 years in the span of 2, and that's not going anywhere. So, that's my view on that.
Okay. Brent, Richard, if you want to add anything to that, otherwise we have another question popped up, but let's round out the channel discussion. And I'll just make a comment on one last, obviously important channel, just the whole food service distributor model. And I think really to emphasize for the audience, I mean, a lot of the, especially fresh food distribution in major metropolitan areas, these are family businesses that have grown up. Some of them are very sizable family businesses. Obviously, you've got giant food service companies, but a lot of produce, et cetera, can tend to be very regional. And again, there's distressed opportunities out there for those that weren't the strongest and weren't able to survive, especially if they were distributing primarily into restaurants. They, many of those distributors suffered significantly, and we're seeing opportunities for deals there. And that was pre-pandemic. Again, on the big side, Performance Food Group acquired Reinhardt, and US Food acquired Smart Food Service a year or so before the pandemic, and the bigger getting bigger, and the regional players are struggling to survive. So with that kind of rounding out the channel discussion, I'm actually going to talk a little bit about supply chain, because our question that popped up from the audience is on supply chain. So, and Michael, thank you again. So you've posted both of our questions for this discussion. Thank you. Will supply chains really shorten and reverse the globalization trends we've had over the last 30 years? And so again, specific as it relates to food and beverage, I know I've seen both examples. I've again seen global companies that produce a food product look to the US as a new market, and still, with the intention to produce them overseas and import them to the US. But yet, you got the farm to table movement, among many other things, pulling against that. So open to the group at large, thoughts on supply chain as it relates to globalization?
I can give the seafood perspective again. So it's globalization is here to stay. You know, you've got the farms that are where they are, you know, in Asia, South America, et cetera. And then you've got quotas for the wild catches. And there's just, it's a global industry and there's no avoiding that. So no, in seafood, no.
Okay. Brent or Richard?
Yeah.
I agree. It's Brandon, go for it.
You can go, Richard. You can go.
Sure.
I'll call
Okay,
Richard.
I agree with Kathleen. Yeah. So I think the anti-globalization is more so related to, you know, national securities, like chip security, manufacturing, industrial capabilities. That's more related to, you know, nationals' long-term competitiveness. But when it comes to food, we definitely see more. I have lived in Toronto for 20 years. I don't see so many like Australian, South American, and Chinese products 20 years ago. But now I do see them, and more so. And even the hottest brand out there, you know, next week, you see it here. So it tells me that it's really a consumer-driven industry. Consumer is king in this world. Yeah, and also for B2B, I think it's more so because of the inflation. It doesn't matter your grocery, your restaurant chain, or your food tech company, your HelloFresh. You need a secure, broader ingredients at lower price, and that force you to go out to freshly produce the farmers, these intermediaries, and that means you have to work with the direct importers or even e-platforms. So it's really the power of saving money. People want to save money for their food. That's the power. No politician can reverse that.
Right. Brent?
Yes, I agree with Richard. I don't see globalization going away anytime soon, but I don't see the supply chain issue and subsiding anytime soon as well, especially with the recent lockdown in China and the overall macro economy. You also see a spike in commodity prices. Ukraine supplies a lot of nickel, aluminum, wheat, and sunflower oil. We also saw an increase in trucking, nearly 300%, driven by a driver shortage, backlog of orders as well. So I think you're going to see a pullback in the near term, but I think it's going to correct itself moving forward.
Yeah, that logistics cost that's a great point, and certainly something is impacting many industries, obviously, but food is certainly a lot of it goes over the road, and that's going to be continue to cost increase. So we have another question. I think I know the answer just based on our answer to the last question, but we'll get the panelists' reaction to the appetite for U.S. companies and investors to invest overseas, and conversely, overseas companies willing to acquire in the U.S. And again, I think I know the answer, so we'll make this a lightning round. Brent, we'll start with you in upper left of my computer screen.
Yeah, that's becoming more prevalent, especially with the big private equity firms. They're building funds in Europe. You're also seeing an uptick in restaurant acquisitions overseas. I think it's going to be more prevalent in the beauty space as well, consumer space, and in the food and beverage space as well. So you're going to see an uptick in that moving forward.
Great. Richard?
Yes, we see more actions happening in South America for the convenience of time zone, and I definitely see more investment coming north of the border, Canada, over the last 3 years. It's getting more competitive. Well, partly because Canada, we're considered almost like half of the U.S. and similar legal environment, similar business culture. I wouldn't say the same, similar. Okay, and also the valuation here is on Canadian dollars and tend to be cheaper. So I do think Canada has the hidden jewels compared to the U.S. markets. Yeah, it's less efficient.
Before I hand it to you, Kathleen, I'm just going to interject a comment that, what Richard just said, we've seen South American companies. That was one of my examples in the background a while ago, interested in U.S. Food and beverage companies, and certainly also working very closely with a company in Asia doing the same thing. So I interjected that because Kathleen, you said earlier you spent a lot of time in Europe lately, so let's make sure we cover that.
Sure, yeah. So two different questions here. Overseas oh, I lost the question. I was reading on the sideline there. Overseas companies looking to invest in North America, absolutely, you know, especially on the strategic side, looking to broaden their presence. I've seen a lot of that. The flip side, and that's US company or US looking to invest in overseas. And I am actually, you know, marketing a European middle market deal right now, not in food and beverage. And what I've been struck with is, you know, certainly from the financial side, how few funds have a mandate that allows them to invest in Western Europe or the United Kingdom. So, you know, if you have, from an investor standpoint, if you are investing in the middle market and you have that ability to, you know, broaden your horizon, so to speak, you're going to find that it's a much less competitive environment. You know, multiples are going to be a little more conservative because it is just by definition, the markets are a little more conservative over there, and you're not going to see as much competition.
Great, thank you.
Steve, you're also seeing Japan become a lot more active in the ag and processors space as well. So that's what we're seeing in the market as well.
Right. Yeah, so globalization. So looking at our next question for the panel, we've got about 5 minutes left, so we're going to cover this question. Again, thank you, Michael. And also want to interject as a precursor some of the topics that, you know, there's a lot of, we haven't mentioned supply chain specifically. We've touched on it a few times, but there's a number of obviously really important aspects of the supply chain as it relates to food. We just talked about globalization, but traceability and responsible sourcing and the push for plant-based foods and the whole integration of 3PLs, et cetera. So just kind of wanted to throw those topics out to our audience. You know, we're certainly cognizant of supply chain being important here. So that somewhat touches on, do you believe the trend of consumers concerned about carbon footprint of food and sustainable sourcing will ever reach mass appeal in the US the way it already has for young people and rich people? So a very, very good question, Michael. Again, thank you for helping our discussion here. We love the interaction. So carbon footprint, sustainable sourcing, traceability, thoughts on that from our panel?
So I would say follow the money. And, you know, to anybody who's in the private equity investment banking eco space, I'm probably telling you something you already know, but ESG has taken, you know, a really, you know, outsized emphasis, not you know, at the expense of other investment criteria, but it's right up there. And so, you know, I don't know, does it even matter if there's mass appeal beyond just young and rich people? Because if the investment dollars are forcing the companies to focus on carbon footprint and sustainable sourcing, then we are all going to ultimately be consuming food that has that in mind, because that's how the capital is pushing companies to operate.
Yeah, that's a great point. And our ESG practices, you know, getting more and more inquiries, as are any consulting practice in that space now. And several conferences I've been at recently, a very consistent theme among the private equity professionals of how they're addressing that in a very proactive, positive way. So I guess since I said private equity, Brent, your guys' view on that topic?
Yeah, so we're seeing this become more prevalent. But one of the things I want to harp on what Kathleen just said is, you're seeing the biggest wealth transfer from boomers to millennials, and they will have the most disposable income. And that's something that's really near and dear to their heart. So I think this is going to be more prevalent in the marketplace moving forward.
Great point. Richard, anything to add? Otherwise, we'll do one last topic very quickly, but go ahead.
I agree with both of them. I think it's just like a retirement, right? You know it's coming, but it's slow. it's a long-term trend. There's nothing really short-term you can grab on. But I understand that in Canada, in the private equity world, there is a big fashion to come up with ESG funds. Most of the big brands in Canadian capital markets, they have a ESG, consideration involved there.
Great. Well, one topic we talked about as a panel, again, we've got about a little less than 2 minutes, so real quick answers, but maybe Kathleen, you can have a little longer answer because you brought this up in our panel discussion. Touched on it a little bit earlier about alternative sources of capital and financing in the food sector. And again, we've touched on it in a few points in this discussion, but a good topic to end on for the group, what you're seeing and things that they should be looking for.
Right. So, as I mentioned briefly before, a number of the companies that I'm seeing in this space have managed to take on a fair amount of leverage over the last few years. Banks have been pretty accommodative in their underwriting standards, and cheap financing, very cheap debt. It's hard to avoid that. And so now you've got companies that are in this period of potential dislocation because we don't know, to Brent's point, what the second half of the year is going to look like. And also a rising interest rate environment where they're all of a sudden they're, L plus 3 or 4 and L meant nothing, but L, there's actually a percentage tied to that too, is going to come into play. So, we do see, I see it, with a lot of companies that I work with, that they're looking for some growth equity to take out and to deleverage and to recapitalize their balance sheet and to make sure that they're in a good position to take advantage of any disruptions that may take place in the market in the coming months, because of everything that's going on.
Great. Well, thank you. And we've hit our time, so I'll cut us off there. Panelists, thank you much. Great discussion. Hopefully our audience enjoyed the last hour as much as we did. And thanks, Richard, Brent, and Kathleen, for some great commentary.
Yes, thank you all so much for your contributions. Steve, thank you for leading an awesome discussion. To our panelists, thank you for your insights. To our audience, we hope you enjoyed that. We hope it was helpful. We will be posting this recording to our YouTube channel in the next day or so keep an eye out for that as well. As I mentioned in the intro, we have a number of events coming up, 350 a year. I know a few are relevant for all of you, so definitely check us out and learn a little bit more. To our sponsors, thank you for your support. And once again, to all of you, thank you so much. Stay healthy, be well, and we hope to see you all soon. If you are joining our Deal Connect meetings, you'll want to log out of this link and log into the separate link that was circulated to you yesterday for your one-on-one meetings. Again, thank you all, and we hope to see you soon. Take care, everyone.
Thanks, everyone.